Welcome to Stock Talk with Nico Criticos. Today, we are going to be doing some stock analysis for Airbnb stock. This stock is $117 a share with a market cap of now $74 billion. This year, the stock is up about 21%. And at the beginning of this year, I made some money because I was buying it at $80 and $90 a share. I sold out at like 130, 140, and then I still kept a couple of these shares that you see today. So the first thing we're going to look at is their revenue chart. If we go to their revenue, we're going to see that we're looking at some nice growth of about 27% per year. And the last quarter, they did $3.4 billion. So revenue is looking good, and that is going to get a check. Then we look at net income, and in the latest quarter, net income was $4 billion, but that's only because they had a tax adjustment, which made their net income look higher. So adjusted without that, it's $1.6 billion of net income. So they have very strong profit margins considering they only did a little over $3 billion of revenue. Then the company has not been profitable for long, only a couple of quarters. So that's why we're going to look at price to sales. And the price to sales for this company is an 8. As you can see, it's been at around an 8 since about June of 2022. So about a year and a half now, it's been at about 8 times sales. So that's pretty healthy. And then we're going to look at, are they innovative? I would definitely give that a yes, because that's in the last 10 or 20 years, I would definitely consider that an innovative thing. Market share, yes, it's about 24%. TripAdvisor is about 41%, which we're going to talk about the competitors. We can look at, so just in general, Airbnb has about 150 million plus users, over 5 million listings. So they are the biggest in the space. Even though it says, even though I put TripAdvisor 41%, some of these companies are like conglomerates that own multiple different ones. So like Expedia owns Vrbo, they own Booking.com. I think they own a bunch of different brands. But Expedia has about 70 million users visiting monthly. Vrbo has 50 million and 2 million listings. So Airbnb is much bigger. Then if we go to Google Trends, we can see if we compare Airbnb, Vrbo, Expedia, TripAdvisor, and Booking.com, all of the top competitors, Airbnb has far more searches than all those other companies, which is another good sign. Now, the one thing I don't like, so here, this is their latest shareholder letter. So pretty much just basic things, revenue, net income. The most important thing to look at here is just net income was $4.4 billion, but that included this one-time tax benefit from the release of a valuation allowance on tax-deferred assets. But this is what I don't like. So even though the valuation looks good, they're growing, the balance sheet is great, profit margins are good, the moat for this business is strong. This is the last month of insider transactions. And as you can see, if it was just one, well, right off the bat, there are no purchases. So that's something to keep in mind. Even if we go up here, here's the last 2 years, there's been 0 purchases in the last 2 years, 640 sells, which means $2.6 billion of the stock has been sold in the last 2 years. In the last month, there's multiple insiders here selling at prices between $118 all the way up to $132. So that's the only thing that's kind of suspicious, because if this was a good time to buy, then why is every insider selling? That's the only thing that is suspicious. But other than that, I like the stock. Now, on the Wikipedia page, it says that TripAdvisor earned 35% of its revenue from Expedia. Okay, so TripAdvisor is the conglomerate that owns Expedia and Booking Holdings. So TripAdvisor should be the biggest competitor, right? That's why it says 41% market share, because they own so many different companies. Return on capital is good. It's over 10%. It's growing. And remember, this is still a young company, so some of these metrics even surprise me because they're just getting to profitability. So normally a lot of these metrics don't look good yet. But their return on capital was 22% last year. We look at the last couple of years here, see it was negative in the past. Actually, we're going to look at this on a quarterly basis, because things are just changing rapidly quarter by quarter. So let's look at the last 3 years. No, last 2 years. So here, this is what they're doing more recently. Anywhere from, a few percent all the way up to 12, 13, 14%. And again, I think, these numbers have plenty of room to improve. In a couple of years from now, I'm sure they'll be able to get to 20, 30, if not 40% ROI numbers. And so that will get a check. The equity, the balance sheet is also very strong. We're looking at $9 billion of equity. And when you compare that to where it's been the last couple of years, let's go on over here to the balance sheet. It was $5 billion just a couple of years ago. And well, actually, even before then, it was negative, right? See, it was $5 billion a year ago, and now it's all the way up to $9 billion. So that will get a check. Equity is, unfortunately, doesn't make the cut because it's only 12% of the market cap, which is fine. This company trades at a higher valuation. On Qualtrim, it says that it trades at 15 times trailing earnings and 30 times forward earnings. And when you go to their analysis page, it looks like they're going to do $3.60 of EPS this year, and then a slight jump to $4 of EPS next year. So you can let's do 118 divided by 4, and we get 30. So you're paying about 30 times next year's earnings, which is not really cheap. But again, this company has a strong moat, great balance sheet, profit margins. They got a lot going for them. They're growing revenue at 27% per year. Well, this year they only grew at about 13% or something, but over the last couple of years, they've been growing 25 to 30%. Share count decrease, yes, by a couple percent. So that's good. The assets are not 2x the liabilities, but again, this company is actually pretty close to it. And most companies in general, even established ones, don't have ratios as strong as this. So that's a pretty good sign. Profit margin over 10%. Yes. Let's go to that chart. We will see here on Qualtrim that the margins are, again, this last quarter was an outlier, but the last couple of years, 26%, 6%, 16, 42%. So again, it's jumping all over the place, but still their numbers are pretty strong. Then we look at cash and receivables of $17 billion. Again, very strong balance sheet, lots of cash on hand, which is good. And they're only doing a couple billion in net income. No dividend yet. The company is over 10 years old, founded in 2007. And the free cash flow is also improving. If we look at this chart, you can see quarter by quarter. Well, this is the adjusted free cash flow, but regular free cash flow, 1.3 billion for this last quarter. And so things are looking pretty good for free cash flow too. So I like this stock. I like the company. Valuation is in line. I don't mind paying 30 times earnings. 8 times price to sales has been the norm for over a year now. And because it used to, before that, it traded at 16, 17 times earnings. And this stock used to be like $200 and something dollars. But now, interest rates are up and the market kind of changed its sentiment. So that's why we're looking at $117 for this stock. So it's possible the stock goes lower, but if they keep growing the way they have been, then I think this stock can be $150, $200 in a year or so from now. So I am interested in buying, but I'm worried and suspicious of why these insiders have all been selling, which makes me think I'm not going to buy right away. I'm going to watch this stock for the next couple of weeks and see what happens. If it goes to like $100, $90, then I'll definitely be interested in buying some shares. But right now it seems kind of weird. So I'm just going to keep an eye out for it. But that is my analysis for Airbnb stock. I will see you in the next video.